Non-farm payroll Friday once again, and I guess you wonder how to trade it or what to do with the payroll, or why sometimes one number is more relevant than the other. So let's take a look at it, at the whole report, and understand why some numbers are more important than others in certain times of the months and different months, and why these numbers are so relevant, or where, right? So let me start by sharing with you the macroeconomic calendar, right? As you can see, the non-farm payroll report is not just one number. We have different numbers that compose this report. The first one is the unemployment rate, right? The second, the relevant number, is the headline, the non-farm payroll report, which represents the number of new jobs created in the past month. So if we are in June, this represents the number of jobs created in June, sorry, the labor participation rate, and we have three different average earnings, right? Let me start by saying this. The non-farm payroll report used to be a big market mover, right? And it's not that relevant these days. And that's because the Fed principal objectives, right, is to keep unemployment low, somewhere below 5%, right? And to keep inflation at the 2%, right? Or nearby, not higher, not as low as it's these days. So those are the main targets for the Fed. And what happened ever since the crisis back in 2007, and with depression or deflation hitting the US, we also had high levels of unemployment, right? We are going to take a look at them in a few, right? And the Fed cut its rates, right, down to 0 or 0.10, floating in between. And this kind of report, the monthly payroll report, was one of the two legs in which the decision of rising rates rested, right? The US needs employment to grow and inflation to grow, right, to decide a rate hike. That's why the report is so relevant. But what happened? To be honest, and if you follow the numbers, employment has become a less relevant issue for the Fed. I would say that we have been over a year having really, really good numbers in the US, right? But inflation remains subdued. So at some point during the past 4 or 5, even 6 months, the non-farm payroll report was not that huge market mover that it used to be. Why? Because it was going good. Employment is growing steady in the US, and the Fed is not worried about the employment situation, but it's still worried about inflation, right? Anyway, we had a shock last month, right, with a really lousy reading, but it was an exception. But sometimes the headline is important, sometimes the unemployment rate, sometimes it's another figure. So let's take a look at each one of them to try to understand why these are so important, okay? The first one is the unemployment rate. As I was saying, we had a spike of unemployment in the US by the end of 2009, right? Unemployment reached 10.2%. It was huge. The Fed is comfortable when the unemployment rate is around 5% or below, as we are these days, right? Even a bit higher is not a big concern. And if you take a look at this chart, you will see that unemployment has been within Fed's comfort zone ever since the beginning of 2015, right? So despite the number may float in between 4.6, 5.2, the fact is that it's not as relevant as it used to be when it was around 10.2, right? The decline in unemployment rate means the economy is growing, it's creating new jobs, and then there is more hope that the US economy will grow and therefore that the Fed will rise rates, right? The non-farm payroll headline, the big number, right, which in this particular case was pretty negative, but anyway, right, it's the number, as I said, the number of jobs created during the previous month. If you take a look at the chart, right, we have been between 140, 150, and even 250, 260, right, for the past almost 2 years. The average, right, disregarding this 2016, sorry, was around 240,000 new jobs a month created in the US for the past 2 years, right? If you can take a look at the chart and you see it, the trend has begun to move lower in this 2016, but still this lousy number we had in here seems to have been an exception, and that may get confirmed or not with the current report. Anyway, just create, right? Market understands it as a more healthy economy, and therefore is a fundamental support for the greenback, right? Usually a strong number, something well above the market's consensus, what the market is waiting for, right? Usually gives the greenback a boost, right? But a couple of years ago, we start also looking at the participation rate, right? This is the number of people that is either working or looking for a job, right? So if the number is below previous one, if the participation rate starts to decrease, means that there's either less people working, right, or looking for a job, right? And when this low number comes along with a low number in the unemployment rate, right, it tends to filter it, right? Filter this one, right? Because a lower number in here tends to be positive. If we have less unemployment because there are less people looking for a job, then this decline, the decline in here neutralizes any decline, which is positive in this case, right, that we may have in here. So those two get neutralized and the market trades accordingly to this headline jobs creation, right? Adding to all of this, we have the average weekly, hourly earnings, monthly and yearly. These numbers tend to be less relevant in the past, but really, really important, because take a look at the average hourly earnings monthly basis, 0.2%. Salaries are growing at a very slow pace in the US, right? And if we don't have big salaries or stronger salaries, then the people won't spend its money. And if it doesn't spend its money, then inflation won't pick up. So back to the beginning, the main issue here, the main issue in the US these days is low inflation, right? And average hourly earnings are an indication of the possibility of that inflation rising or not, right? If you earn more, you will spend more, and that will mean a healthy inflation in the country, right? So when we have unemployment rates and the level for participation, one neutralizing each other, and the non-farm payroll headline pretty much in line with the consensus, then the market will move accordingly to salaries, right? That is how the market acts or reacts to the payroll. Added to this, there are a couple of more things that depend on each currency pair traded, right? What I'm trying to say is that currencies react differently to dollar strength or weakness depending on how the report comes, depending on the currency and how stocks react, right? The number one currency that will react to a payroll report will be the Japanese yen. If we have a really outstanding number, a combination of numbers that we have discussed, then the most likely scenario is that the dollar Japanese yen will be the first pair to rise and the only one that will probably maintain its trend all through the American session, right? And the same goes for a negative reading. The dollar Japanese yen will plummet and the trend will probably extend until the week is over, right? The euro and the pound will be trading mostly range bound, right? The payroll has not been able to trigger strong movements neither in euro dollar or pound dollar for at least a couple of years, right? Unless we have really shocking numbers with big deviations between what we are getting and what we were expecting, the pairs barely react. We have probably initial spikes either side of the ball, depending if the numbers are good or bad for the greenback. But the euro and the pound tend to retrace back to their pre-Nonfarm payroll levels if we don't have a really shocking number, right? And we will probably remain range-bound. On the other hand, the other currencies that are actually moving strongly when we have a payroll are the Canadian dollar and the Australian dollar. Why? Because both commodity currencies are also linked to stocks, right? So those two won't trade accordingly to dollar strength or weakness, but those will probably trade in line with stocks. If stocks rise, then the Aussie and the CAD will probably rally. And if stocks fall, those two will probably go down regardless if the report is good or bad. When it comes to the reaction in stocks, it will depend on how the market feels that day, to be honest, right? If a market is like these days, not waiting for a rate hike anytime soon, right? And we have a strong report, payroll report, then stocks will probably rally, just considering that more jobs means a healthier economy, right? If the market is, on the other hand, waiting for a soon-to-come rate hike coming from the Fed, a strong report will probably put stocks under pressure because a sooner-to-come rate hike will mean less liquidity for stocks, and therefore stock traders will tend to take out their take-off profits, right, and send stocks lower. But that's a certain scenario, right? If the other scenario is that okay, we don't expect the Fed to act these days, and in fact we're expecting more liquidity as the Bank of Japan or the United Kingdom had anticipated for this upcoming months. The most likely scenario is that a strong report will probably trigger strong rallies in equities and of course probably commodities too, particularly oil. I would say I want there to risk watch on gold because gold has a particular reaction, not clear one to each payroll, so many different scenarios. But stocks and oil will probably rise if we had a good payroll, and therefore the Aussie and the CAD would follow. There is still one word of warning when it comes to the Canadian dollar, that many times Canada also releases their monthly employment figures at the same time with the US. So when that happens, which is not every first Friday of the month, then the pair is too risky to trade and could do anything, either go up or down. Will depend, of course, in how both employment reports come. So if you ask me, if you want to trade payroll, dollar Japanese yen, the Aussie dollar are the first one choices, right? The first two pairs choose to trade. The euro, the pound, if you want more less risky trade, right? Leaving aside whatever is going on with the Brexit, it stays with the pound. And the last one I would choose to trade will be the Swiss franc or the Canadian dollar. Okay. Well, I do believe that's the basic. Hope you like it. Hope you enjoyed it. If you have any comments or suggestions, we are here. And thank you for listening. Okay. Thank you.